You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to Watching the Financial Survival Network. Well, is the storm over? Are markets returning back to normal? Or are we perhaps in the eye of the storm? Well, let's talk with John Rubino and find out now. John, welcome back. So markets went up big on Friday. Looked like they're, pretty even today.
Hey, Kerry. Yeah, a day without some really dramatic thing happening is kind of leaves me bereft. I've gotten so used to action now that a boring day, which is kind of a normal day historically in the stock market, seems really strange for some reason. But I suspect it's just like you said, the eye of the storm, because there's still so much crazy stuff going on out there, all of which affects the financial markets one way or another. So I think action is coming of some sort, probably bad, but who knows, maybe really good from the standpoint of the stock market, but action nonetheless. So we'll see. Yeah,
well, 2 days in a row of them not going down. I mean, but you know what I don't like when I see mixed indices, where I see the NASDAQ down and the Dow and the S&P up, or vice versa. That is a sign of potential fracturing in the market and could lead to an even more rapid decline. We've seen this before. And like you noted here, like SPACs are dead, NFTs. What's next here?
Well, the way bubble markets die, both in terms of stock prices and asset prices, and in terms of general economic growth, is that you get trouble at the periphery first. In other words, the kind of shaky assets or less efficient companies or less well-run countries that only did well during the bubble because there was so much extra liquidity sloshing around that it ended up out there on the periphery, bidding those things up and making them look a lot better than they were. As soon as the spigot gets turned off, those are the things that fail first. And in the case of our financial markets right now, that would be the SPACs, which are basically just blind pools. It's like a blank check that you write to somebody who promises to go out and buy something really attractive and make you money, which is that's too dumb to even need to be explained. And what was the other thing? Oh, NFTs, which basically aren't really anything. They're just images of something that you can get an image of anywhere out there online, but it's listed on the blockchain that you own the original image, or it's not something that makes a lot of sense from an investing standpoint. Yeah, they got bid way up in a lot of cases, but they're crashing now too. And I think both of those markets are liable just to dry up because they're such obviously bad ideas that once they have a period of underperformance, they're liable just to shrivel up and die. And then what was the other thing that's going? There's another thing. Stablecoins were in the news just lately. Yeah. And stablecoins are basically versions of Bitcoin. They're an asset that trades on a blockchain, but that represent something else. And there was one that was pegged to the US dollar. There still is. It's just, it's not what it used to be after the last couple of weeks, but it meant to always trade at $1. And that was a vehicle for being able to move money instantly all around the world at a fixed value. It seems like that at least fulfills an actual function, unlike SPACs and NFTs. But one blew up. A big one blew up. Now, what they had done was they set up the algorithm that was going to maintain the value of the stablecoin at $1, and they bought a lot of Bitcoin in order to back it. In other words, if it needed propped up, they would sell their Bitcoin, and that would take care of it. Well, it tanked. They started selling their Bitcoin, and that contributed to the bloodbath in cryptos across the board over the last few weeks. And so it's not clear what the future of stablecoins in general will be now that you've seen what happens when one of them blows up. There's really no recourse. You just lose your shirt. So peripheral assets are starting to behave really badly. And that is a sign that this bubble, the everything bubble, may be bursting. And if that's the case, then the carnage moves from the periphery into the center. And that's kind of already happening too with big tech. Most of the FANG stocks are in bear markets right now. They're down by more than 20, or they were down by more than 20% prior to last Friday. I don't know what they're doing today, but they can't be doing much today because the overall markets aren't doing much. But that's where we would expect the trouble to migrate if this is the bursting of the everything bubble, and if the peripheral assets are a sign of things to come.
All right. So we have a question. It says, a question for you or the Rube. And this is kind of related. If I can pay off my mortgage now, and this was written by Tom S., if I can pay off my mortgage now by liquidating my metals holdings and eliminate the interest over principal payments, would that make sense? I'm currently paying more in interest than on principal, or should I wait to see if my metals holdings will be my savior when hyperinflation arrives? I accept no financial advice, nor will I act on my own on any advice you offer. Just a hypothetical question. So you're not giving out financial advice here. What would you do in this situation, John?
Right. Well, think about what you own and how you can invest it. Say, count your metals, in other words, your gold and silver bullion, as money. So you got this money sitting there, and it might go up in value, might go down in value going forward, and it doesn't yield anything. And over here, you've got this mortgage. Let's say you're paying 5% on a mortgage. So would you invest your money that you presumably own in a safe place right now, not in a bank, but you own it physically? Would you invest that at 5%? Because that's what you'd be doing if you use that gold and silver to pay off a mortgage. And if that seems like a really good deal to you, then you should by all means do it. I would say that I probably wouldn't do that. I would take dollar cash and pay off a mortgage at 5% in a heartbeat. But I think gold and silver have upside in terms of dollars over the next few years that really dwarfs a 5% return. So, you should continue to own some gold and silver. That's investment advice I will give you. Do own some gold and silver going forward, and only use that for some other kind of investing. In other words, sell it to invest in something else. If you've got plenty of it and you're just cashing out some, if you've got maybe an uncomfortable amount of gold and silver and you want to cash it out and do something else with it to diversify, that's one thing. But I wouldn't sell your last gold and silver coin in order to pay off a debt unless that debt was coming right at you. The repo man is coming to take your house away or something like that. Otherwise, I'd hold some precious metals for the long term.
Agreed. I just feel like you're better off being a debtor now than being a creditor. With rampant inflation, 8.9%, 8.3%, whatever they say it is. We all know it's much higher than that. Just go over and look at John Williams at Shadow Stats. Honestly, it could be upwards of 20%. The way we're heading now, it's accelerating. Look, John, gas prices hit record highs just this week. All over the country. It's a great time to be a Tesla owner.
Well, yeah, actually, this leads to a related question that is, I think, a much more extreme version of this idea. If you think the dollar is going to continue to lose value dramatically, then the logical step from that appears to be you should borrow money, you should leverage yourself to the hilt, right? And then pay that money back out with depreciated dollars. So, you borrow a ton of money, you buy some real stuff, and that real stuff tends to go up as the dollar goes down. So you win both ways. That's, it's a tempting thing because logically, if it plays out the way we're saying it's going to play out, you would make a lot of money. But the risk of borrowing a lot of money is that you have to make the interest payments on those loans. And if you can't do that, then you lose everything. So making a leveraged bet against the dollar or on gold and silver, which is sort of the same thing, is something that some people will do and make a lot of money by doing in the future, but it's also really dangerous. And that's not something that most people should do, just because taking on a lot of debt involves a lot of dangers. And you don't want to saddle yourself with the kind of risk that involves normally. Like, you should be using your money to put your mind at rest. In other words, to create serenity in your life, not to create extreme stress. And borrowing a lot of money creates extreme stress. So maybe, pay off your mortgage, yes, but taking out a new mortgage or some other big loan in order to bet against the dollar, that's much riskier. And you shouldn't normally do that unless you're a very sophisticated player.
Yeah, well, that is true. You are effectively betting against the dollar, hoping that you can pay back your debt in much cheaper dollars. And in Germany, in the Weimar Republic, a lot of people did that. You hear anecdotal tales, John, of creditors like running away from their debtors who've got wheelbarrows full of money wanting to pay off their debt. And they said, no, we don't want it. We don't want it. And that's the anomalous thing that happens when hyperinflation sets in, or extremely high inflation. Doesn't necessarily have to be hyper. Hey, if you're losing 10% of the value of the dollar per year, and you think it's going to go for the next 3 years, then you're basically paying it off in 70-cent dollars when you borrowed what were at the time 100-cent dollars. So there is a strategy there, but it's not for the faint of heart, because you could wind up like in a Great Depression scenario with a deflation, and that's just the way it works. So we got a baby formula shortage, we got bird flu, spiking egg prices and supply, like 10% of the hens they've had to eliminate because they had bird flu. Imagine if they got rid of people the way they get rid of animals because they get the flu,
Yeah, it's hard to think about what happens when there's something like bird flu or swine flu or something, how they just kill 1 million chickens or pigs, just go in there and they don't do it in a pain-free way. They just do it in a hurry. But one of the reasons that we probably do have more inflation in our future, in other words, it's not transitory, it's not going away, is that there's an awful lot of weird shortages breaking out now for reasons that have nothing to do with monetary policy. We created a ton of new money during the pandemic, which, other things being equal, ought to lead to higher prices. And we certainly got that. But at the same time, we've got all these accidents and fires and plane crashes and things like that into food processing plants, where something like 20 of them have had something serious happen to them. And the baby formula thing you mentioned was FDA action, and they had a safety violation. So the government shut down one of the big baby formula manufacturing plants in the US. So there's a big shortage. And these, bird flu, that has nothing to do with economic mismanagement or monetary policy or anything, but it's sweeping through the chicken population in the US. So we're going to see higher chicken prices, and eggs are already going way up. And so we've got a lot. Oh, and there's a lot of weather related things too. There are plantings being delayed by wet weather, and other places where the harvest is being interfered with by dry, hot weather. And so there's a lot of stuff going on. It's a perfect example of the old saying, when it rains, it pours. We made a bunch of stupid financial mistakes, which were clearly going to result in inflation. But meanwhile, we got all these other things that are seemingly beyond anybody's control, unless those accidents at the food processing plants are sabotage, which I wouldn't put past our current government at all, but I have no inside information about it. So there's an awful lot of stuff going on. Oh, and diesel. That's right. There's a big diesel shortage in the US, and we don't have enough diesel processing capacity. And there are no plans to build any new refineries or anything. So this is just going to go on until some supply related thing, till demand destruction lowers the demand for diesel and it comes back into balance. These are all things that that seem unrelated, and they don't have anything to do with monetary policy, but they're here. And so they're having an effect on prices and supplies. And most of them don't really look resolvable in the short run. The baby formula thing, by this time next year, maybe that plant will be back to operating and the baby formula will be available. But it's not clear how soon we get enough fertilizer or diesel to make the system run smoothly again. So I don't know. This looks messy for at least another year, and it could be that we have shortages and rising prices for quite a bit longer than that.
Yes, the diesel one is particularly upsetting because everything moves by trucks, and when they're paying $6-7 a gallon, well, those trucking companies are going to have to raise their prices. You get into the whole supply chain, the nitty gritty of it, and why it's breaking down. Well, in other news, Bernake has been very critical of the FMOC officials for being too dovish. Talk about the teapot calling the kettle black.
Don't just survive, thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yes, Ben Bernanke actually criticized another central banker for being too easy. That is Hitler telling Stalin that he's being too nice. This is just crazy. Bernanke is. We've had a string of central bankers who have all been kind of cut from the same cloth and made the same stupid mistakes, but Bernanke might be the biggest because he was really aggressively easy, basically almost the whole time he was in office, and he got gave us the housing bubble, and then the crash after the housing bubble that turned into the Great Recession. That was his territory there, and all the way into the beginning of the bursting of the housing bubble, he was on record as saying, "No, houses never go down in price, and this is well contained in the subprime sector, and don't worry." Saying stupid things that anybody else could see just by looking around were false. And so he's got that paper trail that he has to deal with, that has basically ruined his credibility. But now, way after the fact, he's out here criticizing some other central banker for being too easy. It's funny.
Unbelievable. Well, in other news, the 20 European nations agree to start paying for gas from Russia in rubles. And what do you make of that?
I think the whole de-dollarization thing is one of the least understood but biggest stories that is out there right now. Basically, we've been using the dollar and our control of the global payment mechanisms as weapons to punish anybody who steps out of line from the official policy of the U.S. global military empire, and obviously that's a hard regime to live under if you would like to have a little bit more freedom of operation. So China and Russia and India and a lot of other countries are sick of U.S. dominance and of us abusing the privilege of having the world's reserve currency. So they're looking for ways around it. And they've all along, they've been, cutting deals to trade with each other in their own currencies and things like that. And so there's been a steady decline in the percentage of dollars making up the world's central bank's foreign exchange reserves from, I think, 70-something to 50-something today percent. And so it's been ongoing. Countries kind of getting out from under dollar hegemony. But the stuff we've done lately with the Russia-Ukraine war, where we just we froze Russia's foreign exchange reserves, or some of them, and kicked their banks out of the SWIFT excuse me, international payment settlement system. So Russia now is actively looking for ways to get out from under the dollar, and they've just decided that they're only going to take rubles for natural gas. Now, everybody thought that was just a bluff because the Europeans would never do anything like that. But it turns out Europe is so dependent on Russia's energy, natural gas and oil, that they basically can't get by without it. So they're folding. They're coming up with rubles to buy natural gas. And what that means is there's a lot more demand for rubles on the global market, which is strengthening the ruble's foreign exchange rate and at the same time sending an awful lot of money to Russia. They're running a nice big trade surplus right now. And so you can make the case that they're actually doing pretty well financially. They're selling oil at very high prices in the global market. They're selling natural gas to Europe at extremely high prices. So presumably way more than their production costs. So they're making pretty good money there, and their currency is holding up when you think their currency would be just getting smashed with all the sanctions that the West is imposing on them. So this is a very big deal because other countries of the world who are mad about how the U.S. is abusing them financially are looking at this and thinking, wow, I have options now, And so I think we'll see an acceleration of de-dollarization going forward, just because Russia made it clear that it's something that you can get away with now, and there are a lot of benefits to doing it. So that's going to be a very big deal. Now, we'll be talking about the demise of the petrodollar for the next few years, and it'll be a bigger story going forward because it'll affect the value of the dollar in a negative way going forward.
Yeah, and this story that was in Zero Hedge, I think they're called Riden Associates, said that European natural gas prices to triple in perfect storm. And natural gas now really is more important in many ways than petroleum. So much conversion has taken place. It was so much cheaper, especially in the U.S. per BTU than petroleum-based energy. And now with what's happening with Russia, everything else, can you imagine tripling of the prices? They could be going $60, $80, $90 per million, I should say per million BTU or per 1,000 cubic feet. I mean, that's going to send all of Europe into a major tailspin.
Well, it's a very big deal from the point of view of the money that people have to spend on other stuff, right? So if you have to put twice as much into heating your house or whatever else you do with natural gas, you don't have that money for anything else, which slows down the economy dramatically. But the ECB cannot loosen. In other words, it can't flood the system with money to make up for the decrease in disposable income for consumers because inflation is so high. So they have to raise rates into this squeeze on European consumers with, it's not completely clear what that's going to do, but it can't be pretty. If the ECB tightens at the same time that energy prices are going up, that's like a massive tax increase on Europeans, which will slow down the economy dramatically. And so we'll see. It could be that because of these and a few other things, by the end of this year, the European Central Bank and maybe the Fed will be back to easing again, just because the pain that voters are suffering is intolerable, and the government just does a U-turn like they have in the last 3 or 4 equities bear markets. This is a much more serious situation because during those times, inflation was really well behaved, at least in terms of official numbers. Now it's running wild, and so they can't capitulate as quickly and as easily and go back to easing as they did before. So they're going to have to wait a little longer and create a lot more pain in the system. And so we will see energy prices spiking and the Fed rate or the ECB raising interest rates in Europe this year with, potentially catastrophic results. We'll see exactly how it plays out, but it sounds very messy from their point of view.
Yes, very messy. And, well, I guess we're just going to have to find out where this is all heading. It's just a matter of time. One final story wouldn't be complete without it is Elon Musk puts Twitter purchase on hold because there's so many fake accounts. Is he trying to just get a better price? Is he having second thoughts about it? What do you think's going on here?
He's a kid playing with his toys, basically. He just enjoys this kind of thing, stringing people along and getting them to jump around. Yeah, he's a troll. But it's completely legitimate to think that once he and his guys started looking into Twitter, they said 5% or less in their official filings. They've said 5% or fewer of their accounts are robots.
Yeah.
And non-humans. And it could be that they find that it's much higher, and that means he's not buying what he thought he was going to be buying. And so they have to sort that out somehow. But it wouldn't be a surprise if an awful lot of Twitter accounts were just bots, just things that are programmed to respond in certain ways to certain keywords and stuff like that, and designed in a lot of cases to make the discourse a lot coarser. In other words, they're designed to come back with criticisms and personal attacks and things like that. So we'll see. I don't know. It's pretty funny so far. We don't really have any details beyond that, but it's just a funny situation because it's funny to see these guys running these big media outfits, especially in social media, get exposed for what they are. They were scamming. For instance, as soon as Musk announced that he was going to buy Twitter, did you see the story about how a whole bunch of accounts started cropping back up again? People who had been kind of shadow banned all of a sudden started getting traffic and subscribers and things again because they were hiding the algorithm, that's the equivalent of shredding all the paper before new management comes into a company. Well, in this case, it looks like they're deleting their algorithms that used to suppress inconvenient voices, and all of a sudden, these guys are getting way more traffic. So it's a funny process. So we'll see how it plays out. I think I'm definitely hoping that that Musk ends up buying Twitter just because it'll be entertaining as hell going forward.
Yeah. Hey, man, it's like nobody will be able to shut him up then. And look, I believe. What do you think the odds are he's going to buy it?
I have no idea. It depends on what he finds. There also could be an issue of he's buying Twitter in the beginning of a tech bear market. So it could be that by waiting a year, he could save $20 billion. And he's extrapolating out the recent action and coming to that conclusion. So maybe it makes sense just financially to wait, having accomplished a lot of what he wanted to accomplish by exposing Twitter as the borderline scam that it is, and then come back in later with with 30 billion instead of 45 billion or whatever, and then buy it at the bottom of the cycle. So there's a lot of options out there, a lot of reasons to think that it could go one way or the other.
I think he's going to buy it. I don't think he cares about money. That's not his thing. And, unless he's lost enthusiasm for free speech because he's been so attacked, especially by the left, for the idea of taking over a portal like Twitter and actually being a proponent of allowing everybody to have a discussion, to actually debate topics, to have informed discussions about the major issues of our day. Nobody wants that, especially the government. Government doesn't want any discussion or any challenge. And look, if they could figure out how to treat people for COVID, they should be able to figure out how to treat a chicken for a flu. I mean, just give it chicken soup, right? That's what my mother did. Give it chicken soup and it'll probably get better. But that should be a discussion. That's a matter for Twitter to handle, not us. Let them figure out how to treat the damn chickens, the pigs, the cows, whatever. But there's got to be a way to do it. In any event, that is it for today. Make sure you go over to John's site, dollarcollapse.com. Sign up for his free newsletter. Same with us, financialsurvivalnetwork.com. Send us your questions. We will eventually get to them. KL@kerrylutz.com. John, we'll talk to you in a couple of weeks.
See you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.